If you're only using the P ratio to pick stocks, you might be missing out on some big opportunities. Let me show you a magic formula that can help you find undervalued stocks with high growth potential. It's called the PEG ratio. That's price to earnings to growth. The PEG ratio is a simple calculation that answers this question: am I paying too much for the company's future growth? Here's the formula. PEG equals pay ratio / expected annual EPS growth rate. So the PEG ratio is the P ratio divided by the company's expected growth rate. Simple, right, but powerful. A PEG under 1 suggests the stock may be undervalued for the growth it offers. A PEG above 1.5 might suggest the stock is overpriced. So how do you find the PEG ratio for free? Let's break it down. Go to any stock page, click on Statistics, and scroll to Valuation Measures. You'll find PEG ratio listed right there. And if it's not available, use this quick trick. Get the pay ratio. It's usually listed on all platforms. Look up EPS growth estimates from analyst reports. Do the math. Paid growth rate equals PEG. Now let's look at a few examples. Company A has a PEG ratio of 0.5, Company B 1.2, and Company C 2. Which one looks like the best investment? Company A, right? It seems to be the most attractive because it has the lowest PEG ratio. But remember, a low PEG ratio doesn't automatically make a stock a good investment. We're just comparing apples to apples here. Here are some pro tips before you use it. PEG works best for companies with steady earnings, like tech or consumer goods companies. Be cautious using it for startup companies or cyclical stocks where earnings fluctuate a lot. So, don't just ask, is this stock cheap? Ask, is it cheap for the growth it offers? That's what the PEG ratio tells you. Remember, it's not about finding the cheapest stock. It's about finding the most value per dollar of future growth. So before you buy a stock, do the PEG ratio homework. If the stock's PEG ratio is less than 1, it might be undervalued. If it's between 1 and 1.5, it could be fairly valued. And if it's more than 1.5, it might be overvalued. Keep in mind, this is a guideline. It's not a hard and fast rule. Do you use the PEG ratio in your trading? Let me know in the comments. And if you want to learn more about stock analysis, check out the links below. Remember, in the world of investing, knowledge is power. So keep learning, keep growing, and keep making smarter investment decisions. Until next time, happy trading.